the market has very weak legs that it's standing on. The S&P and the Nasdaq have very weak legs because things are sort of falling apart. This is what you sort of see at market tops. When you're at top of a market, it's sort of you're walking on a tightrope. Any little shift of wind could knock you over. So I think we're in that situation now. I think the market probably is in a lot of trouble. Let's find out why.
This episode of the Forward Guidance Podcast is brought to you by Wide Charts. Very happy, very thrilled to welcome back to Forward Guidance Milton Berg of MB Advisors. Milton is a technical analyst who's got a totally different spin than 99% of technical analysts. Milton, it's great to have you back, and I just want to roll out the red carpet for you because in January, mid-January of 2023, when I have to say I was, not bullish, I was somewhat bearish, and most people were exceptionally bearish because the Fed's going to raise rates, we're going to enter a recession. Whatever happens, the market has to go down. Right. And you came on this program and said, I challenged the bears. That was an exact quote of you. And you are close to the most bullish you've ever been in your career and more bullish than anyone on Wall Street, anyone on TV. There were cautious bulls, but you were an exceptionally enthusiastic bull. And I have to say your call has aged terrifically well with, I think, the S&P 500 up about 20% since then, the NASDAQ up 35 or even 40% up, since the middle of January. Mm-hmm. So I really just want to roll out the red carpet and saying, thanks for coming on in January and being so right.
Jack, thank you. I have to correct one error, if you don't mind. You can't say I was the most bullish I've ever been in my career. I actually have been very more bullish very often in the past, much greater than I have been this time. But I did say I couldn't find any evidence that the market was going lower. And at that point, I think when I interviewed with you, we had over 60 indicators since going back to June of 2022, but mostly in October and on. Over 60 indicators that were bullish. We couldn't find one that was bearish. You challenged me with the inverted yield curve. I said, well, that's not really a technical indicator. And I said, it hasn't worked prior to the 1960s. So I really would discount that one. But other than that, I think the challenge was fine because we couldn't find any real indicators. There were emotional reasons to get bearish. It was, looking at the Fed. But the Fed isn't exactly an indicator. Trying to predict what the Fed do was more difficult than trying to predict what the market will do. So I focus on trying to project what the market would do rather than what the Fed would do. And fortunately, yes, it was a good call. I'd like to review it a little bit, tell you why it was a good call, just like we could review it properly. We met in January. If you remember in January, I said, well, this is bear market. The bull market has already began. I said it began because the Russell bottomed in June. As you know, bottomed the day after the Fed, the day before the Fed started raising by 3/4 percentage point. It was kind of amazing that the Russell 2000 made its bear market low just as the Fed began aggressively tightening. And even the S&P 500, which ultimately declined another 2.5% below the June low, that's just a testing level. So actually, I felt that the June low was the panic low. What you look for, a technician, what I look for is sharp changes in sentiment, sharp changes in market action at a low. I said we saw that in June. Everything plus subsequent to that was basically testing. And the proof in the pudding, you were a year later, and the S&P never got more than 2.5% below its June lows of last year. And the great buy signals basically took place from October on. Now, I met you in January, and it was right after we got a buy. We got to say we had over 60 buy signals, but we had a buy signal on January 6th. I'll just review what it was. And a very simple indicator. Again, we have simple indicators, but indicators are the way we call turning point indicators. Our indicators don't use long-term moving averages. They don't look. The pattern analysis is only a secondary part of what we do. We look for concentrated market action that takes place within days of a low or within days of a surge or in a market or downturn in a market. I'll give you an example. On January 6th, the S&P 500 was up on the day. How much it was up is irrelevant for this conversation, but its upside-downside volume was 28-1, meaning the volume of stocks that were up on the day in the S&P 500 was 28 times greater than the volume of downside stocks. It's a very extreme reading. The normal reading should be 1-to-1. Very extreme reading.
When you were in a huge bear market, when everyone's panicking, are there more selling volume than buying volume?
Well, let's put it this way. You don't see this kind of a reading in a bear market, okay? You can't see it early in a bear market rally that's going to last significantly, but you don't see it as the market is about to head down. You just don't see it. But it was just half the indicator. Besides being up, having greater than 28-to-1 upside volume, you also have to have the S&P gain at least 2% on the day, and the volume must have been greater than the day before. In other words, you're looking for three things. You want to see a strong update, 2% or greater. You want the volume to have been greater than the day before, just to show that it wasn't a low volume day, and therefore the market was able to be up. And the third thing you want to do is see 28-to-1 downside. Now, this thing has happened 26 times in the past. I pointed out that day, the median return after this type of a signal is 22.86% within 1 year. And that would have projected about 4,700. We on the show I said we think it will see 4,650 within a year, and that was one of the signals we had at the time, which was a very bullish signal.
That was an exceptionally bullish call for 4,600. That was at a time when the S&P was barely above 4,000.
Well, people are talking about getting back down to 3,000. You know, some of the great pundits were saying, "Oh, 3,000 is easy. Get down to 3,000." We mentioned on your show, we mentioned 4,650 as a target. This particular signal projects to 47.85 basically, but you're looking at the median of all the gains for the 26 previous signals. Then in October last year, we had what they call a breath rust. Most people didn't recognize the breath rust until January 12th, but we had a breath rust on October 28th, just a number of days after the October 11th closing low, and that uses a broad index instead of just using the New York Stock Exchange or the S&P 500. We're combining small cap, mid cap, and large cap indices. We had 2.04 to 1 upside downside advanced decline ratio on a 10-day basis. And that projected to a gain of 20%, which was a 46.50 we mentioned. That's the one I mentioned in the show. That projected 46.87. We rounded it down to 46.50. And that had 37 previous instances in which it gave a bullish indication. So that goes back to October. October 25th is another signal which we mentioned on the last show, which the S&P advancing over declining volume was greater than 9 to 1 in 3 out of the last 10 days. Again, concentrated. 9 to 1 is a very rare reading, but I see 3 times out of 10 days is certainly rare. It usually takes place at the beginning of a bull move, and that projected to a 22% gain. It happened 10 times historically. I think that the one we really spoke about on the last show was the trend of above 4.
Yep.
Yes, what's trend? Is trend? I explained. Trend basically means it's a high trend is a sign of panic selling. It means that most of the selling is concentrating in a handful of stocks. A trend above 4 means basically that the number of volume, the amount of volume in downside is 4 times it should have been relative to how many stocks are down in the day. In other words, heavy concentrated volume in the downside. Now, really, this took place on October 3rd, which I think is 1 or 2 trading days after the small caps made their low and the mid caps made their low, and a couple of days before the S&P made its final closing low. The final closing low was less than 0.5% below the intraday low of September 30th in the S&P. In any event, that was a buy signal we spoke about. That projected to a 21% gain in the S&P, and from that level, that projected to 4481.77. I don't know how we got a little bit above that, but these were of the 60 indicators we had. These are some we mentioned last time. I'm reviewing them now, but in any event, we were bullish. It worked out. I'm glad you acknowledge it. I'm very happy with your Twitter announcement. You know that it was great. It was great. I really appreciate it. Thank you so much. But the question is, you know, with that and at $1, you can't even buy a bottle of Coke nowadays. So let's see what we can do.
Yeah, and so I just want to say, so as folks can tell, you're a technical analyst, but unlike the vast majority of technical analysts, very little of the work you do is drawing lines on a chart. You're looking for historical precedents of the last time this has happened. It's happened 7 times. And the expected return was plus 20%, minus 20%. So you have these buy signals and these sell signals. I think tens of thousands. Sorry, Milton. Just tens of thousands of indicators. And the last time we spoke in January, you had around 60 buy signals and 0 sell signals. How many buy signals do you have now? How many sell signals?
Wow. Well, now we're getting to interesting stuff. Okay.
And then when you said 20%, was that 20% from the low? Well, because we're already up 25%.
Oh no! I'll tell you. No. We actually have not met all our projections. Our basic projection is 46.50. We haven't gotten there yet. We may still get there. If we don't, I don't mind, because a lot of things have changed since then. And so I think I'm going to tell you where we stand now, and then we'll go back to what happened since then. Because we stand now, we got a series of buy signals on August 28th and August 29th. Meaning, there was a correction began on February 2nd. We'll get to that a little later on. And it's actually some indices peaked at February 2nd. As you know, the Russell 2000 never got above its February 2nd intraday high. The S&P small cap index never got above its intraday high, February 2nd. The Hang Seng index never got above its January 27th high. Intraday high, I meant high. And the Hang Seng peaked in January. Many indices actually peaked in February. The S&P is far higher than it was on February 2nd. But the first correction after February 2nd was about 7, 8, 9% in most indices. We had another correction of about 8%, about 8%. We had now another correction of about 5% of the S&P into August. We had about 8% in the NASDAQ, about 13% in the semiconductor index. These are the corrections we just had. Coming out of this correction, we got some buy signals. Let me discuss those buy signals to show exactly what this means. Now, I'm going to say straight off the bat, these are not bull market buy signals. These are buy signals just telling you, cover your shorts. You'll be able to short at a higher price later on. It might be a week later. It might be a month later. It's just telling you the market got sufficiently oversold and that the action off the oversold level was sufficiently strong to suggest that the market's going to go higher. Let me see what we got on day 6. This is on August 28th. 6 days, we say day 6 means 6 days after the low. Now, again, it was a 5% decline in the S&P. It was a 8% in the NASDAQ, 13% in the stocks, and we got a buy signal. What was it? Well, first of all, the 10-day put call ratio was at a 6-month high. In other words, put call ratio measures what people are willing to bet that the market goes down relative to what they're willing to bet that the market's going to go higher. Or individual stocks, how much they're willing to bet individual stock goes down relative to how much you're willing to bet that individual stock will go higher. Now, the 10-day put call ratio on day 6 off the low was at a 6-month high, which tells you, although the market has gained for 6 days, people are still buying puts. They're fading this rally. They don't believe it, number one. Secondly, okay, I understand the 10-day put call ratio was at a 6-month high because we're only day 6 off the low. So there's 4 days in which the market is still going down. Maybe that overweighed the 6 days that the market is moving up. And therefore, on a 10-day basis, put call ratio is still high. However, on the 3-day basis, the put call ratio is also elevated above a level, using standard deviations and historical measures, way above where it should be on a random basis. So you had a 10-day put call ratio high, a 3-day put call ratio elevated. Now, the 3-day put call ratio took place 6 days after the low. So rather than people shifting from bearish to bullish because the market's up, they were fading in this rally. The S&P, it was, as they say, it was 6 days after a low. And this has only taken place 3 times in the past, where you saw a 10-day put call ratio 6-month high, 3-day put call ratio elevated, and 6 days off a correction of at least 5%. You saw it on March 13th, 2007, which was led to the last rally before the great 2007 bull market peak, led to a 50% decline in most markets. So,
and so Milton, folks who weren't working in finance in 2007, it can sound bearish, but from March 2007 to, you tell me, October maybe, that was a bull market. It was
March 2009, the market was down some 45%.
Right, but I'm saying from March 2007 to the fall of 2007.
I'll tell you exactly. The S&P gained 13.58% to the final peak. It actually gained 12.7% to its initial peak. Then it made a secondary higher peak, up 13.58%. NASDAQ goes up significantly more, but the reality was there was a rally, 12% rally. Again, this is not a bull market. This signal is not calling for a bull market. It's calling, if it matches 2007, one more rally to final new highs maybe before the bear market ends. It also took place, same signal, on March 18th, 2008. Now, March 18th, 2008 was during a bear market. And in this instance, the bear market halted. The market continued high at 7.20% for 43 days in a bear market rally. That might be what we're seeing now. You might not see the NDX make a new high. You might not
a bank failed in March 2008, just like it failed in March.
Bank failed. Bear Stearns failed. That's exactly what created this bottom. Exactly what created the 6 months, the highest put call ratio in 6 months, and then 3-day elevated put call ratio. Exactly what caused it. But in any event, the gain was 7.2%. And you saw this again, believe it or not, this year on January 6th. January 6th of 2023. Believe it or not, while we were on I think a couple of days before we had our interview, everyone was bearish. They're so bearish, they were buying puts. and on the 10 days and 3-day basis, and the S&P had gained, the NASDAQ bottomed on December 28th. So this is day 6 off the low. January 6th was day 6 after that low. Anyway, in this case, the S&P continued higher, 7.3% in 18 days, and 17.81% to its final high we saw, I think, on July 27th. So that's a signal we got on August 28th, a reason we covered our shorts and we went long. Let's get what else we saw then. Another signal on August 29th. Now, this is a very broad signal, meaning it's not my favorite signal because it's a very easy, broad signal. It signals very often, but its ratio of success is 87.5%. Now, you think if it's an 87.5% success rate, it's a great signal, but it's not, because you have to have the right nuances. Really, we only corrected 5% into the last correction in the S&P. We only corrected 8% in the last correction in the NASDAQ. This signal often takes place after the market is at a bear market low, after it's down 15, 20, 25, 30%. What was the signal? Number one, the market makes a corrective low. It's 7 days past the low. Count 7 days. 1, 2, 3, 4, 5, 6, 7, August 29th. NASDAQ gained 1.74% on day 7 on volume greater than 34%. The threshold for the NASDAQ is 1.5%. So it's up at least 1.5% on day 7, and volume is higher than the previous day. In this case, the volume was above 34%. So we filtered this for volume above 30%. In other words, I took out all the instances historically where the 1-day volume was less than 30% above the prior day's volume. Secondly, S&P was up 1.45%. Volume was up.
What was that? 1.4.
S&P was up 1.45% on August 29th. I'll speak slowly. August 29th, which was day 7 off the low, and the volume of the S&P was up 21%. So you have two major indices up significantly on the day 7 off the low, and volume is up either 21% or 34%.
And day 7 is 7 trading days, so it's 1 week and 2 days.
The low is in mid-August. You count 7 trading days on day 7. Yeah. Most of our signals take place, these types take place 4 to 7 days off a low. This took place day 7. Now, this took place historically, as I said, 24 times since 1962. 87.5% of the time, the market heads higher. I don't have the median returns here, but in any event, this suggests the market's going high. There were failures. January 28th, 2009, at the end of that bear market, the market went down another 20%. November 10th, 77, August 16th, 72. But I'm not looking at the failures. I'm looking at the success rate, 87.5%. All this is telling me the market should rally. It's not going to go straight down. I'm not saying this, I use that as a bull market signal. It's just telling me the market should rally, and it should not. The weakest rally, by the way, of the 21 instances that worked was 4.45% off the signal date. That's the weakest we've ever seen. So let's say we'll get a minimum of 4.45%, but it's enough to cover shorts and short at a higher level. But we think we'll get more than 4.45% off the signal. Maybe that's day 7. Then we got a series. Of day 7 buy signals. And these are the last buy signals I'll talk about now, because mainly I want to speak about the problems the market is having. But since I was bullish last time and I'm trading bullish now, we're 100% long currently, I really have to point out to you, and which our clients seen already, why we've turned bullish. Why did we cover the shorts, which we placed in July? And these are the reasons. Then a series of buy signals took place on day 7. And I'll tell you what goes into the buy signals rather than talk about each one separately. What goes into the buy signal is number 1. On any days, a 4, 5, 6, 7 off the low, the S&P was up at least 1%, and volume was higher than it was the previous day. That's number 1. Number 2 is you want the NASDAQ to either have its greatest gain in 60 days or its second greatest gain in 60 days. In other words, that day 7 gain, where the NASDAQ gained 1.74%, it must be either its greatest gain in the last 60 days or its second greatest gain. Okay? And number 3, we looked at the fact that the volume on this day in the NASDAQ was increased by more than 30%. This particular combination in the past has seen a median gain within 6 months of 8.84%. That's not a bull market action, but it's enough of a reason to cover a short and anticipate a gain ahead. 8%, it's not so comfortable sitting through shorts where the market's up another 8%, when you're a leverage short. So that's one indicator we saw. Another one is very similar to this one, in which, by the way, that has 4 precedents. Another one is the same situation. Is day 4 to 7, the market's up on the day, volume is high. But in this case, the CBOE 10-day equity put call ratio made a new 6-month high 1 day ago. In other words, on day 7, the market was up, and on day 6, just 1 day prior, people were still buying puts on a 10-day basis. The put call ratio was at 6-month high.
So that's a similar signal to your earlier signal.
Although in this case, although this is not high itself, here we're combining this with the day 4 to 7. Anyway, in this case, the median gain again within 6 months is 10.55%. This is not early bull market action. This is not market thrusting action. The greatest we've seen was up 27% in 1990. The minimum was up 7% in 2005 after the signal within 6 months. And then the other one, there's various combinations of this. Bottom line is only one that's considered a bull market signal. That is this signal. Basically, the S&P had its greatest gain in 60 days. It bottomed 7 days ago. It gained more than 1% on the day, and volume was 20% higher than the previous day. This signaled 5 times in the past, never signaled during a bear market rally. In other words, this signal was always followed by an extended bull move.
And what day was this S&P 500 rally? Was it on
August
Friday?
29th, August 29th, day 7 off the low. Okay. Now, let me give you the historical dates, because, for example, we saw the signal on August 2nd, 1984. We saw the signal on August 2nd, 1996, April 22nd, 1997, October 24th, 2005, and January 29th, 2016. Never took place during a bear market. It never suggested that a bear market was ending. Even never took place at the end of a bear market, or end of a bull market rally. So this is the only signal where I can say it never took place as a bear market was ending. As you remember, the first one I told you took place in March 2007, just a few months before the end of the bull market.
So you mean this historically has never occurred at the end of a bull market?
Never occurred at the end of a bull market, exactly. Never at the end of a bull market, ever. So I'm not going to put much weight into that because I'm going to say, well, still on a 6-month basis, the median gain was 12.90%, which itself not bull market action. Over a year, the median gain was 21%. I mean, you had amazing gains over a year, 18%, 14, 45, 44, 23. It's a nice signal. It's not one of my favorite signals because of the components. And some of the, I use using a minimum of 1% gain in the S&P. In some of the cases, the S&P gained 2 or 3%. But just saying why I'm bullish here, why I'm no longer positioned short, although I'm going to talk to the market's really in a lot of trouble. I think the market probably is in a lot of trouble. Let's find out why.
Why is the market in a lot of trouble? So you talked about your buy signals. Now you're going to talk about your sell signals.
Now I'm talking about my sell signals and why the market seems to be in trouble. Not necessarily sell signals, but what's wrong with this market? There's something very, very wrong with this market. Let's take one thing at a time. First of all, I want to first mention a mistake that everyone's been making. I've been hearing it all along. This is the one saying this is the greatest gain ever in the history of the NDX. You've heard that many times. This is the greatest gain ever for the NDX. Well, that's just totally not true. If you look at, they're saying that year to date, it's been the greatest gain ever, the NDX, but bull markets don't start year to date. Bull market starts at any random date.
NDX is a NASDAQ.
NASDAQ 100. So I did it like this. I said, let's look at any time in history the NASDAQ 100 gained at least 41%, which it did this time. And let's see any time this happened after the NASDAQ 100 declined at least 30%. Well, that has happened in 1987. Now, the NASDAQ peaked in July 17th. I think it was 163 days after the low. So far, its latest peak. Let's see in the past how much has NASDAQ gained, NDX gained by day 163. Well, in 1987, it gained 43.2%. In 2002, it gained 47.29%. In 2008, it gained 47.35%. In 2001, in the bear market rally, it gained 52%. And in April of 2001, in the bear market rally, it gained 49%. So this 41.84% we've seen now is actually the weakest NDX 100 rally ever in a bull market, not the strongest. The mistake everyone's making is they're saying, well, it's the greatest year-to-date rally. Who cares about year-to-date? We don't, nothing.
Yeah, that is very weak analysis, Milton, just a year to date. I mean, when people say this is the best start to the year ever, I mean, I've done that. I posted about that. So but saying that, oh, this has never happened. Going back to 1951, there's never been a 6-month start to this. It's the first 2 quarters of a year have never done this. That doesn't make sense because you should start. Let's see. I don't know how many days are in a quarter. It's 20, 60. It's 120 days. You should be doing a 120-day rolling average. Starting a year every single part of the day instead of just starting at the year.
You're getting there. You're going to start learning technical analysis. You're getting there. Good. Hopefully. Listen, let me tell you, number one, why is market in trouble? There's 8 reasons to doubt that it's bull market to continue. Number one, on a sentiment basis, as you know, investors' intelligence, AAII sentiment, and just seeing what's going on Twitter and going on in the TV shows, people are accepting the fact that there's no recession ahead. I've seen I looked at some of your shows, Jack, and some of the great bears are saying, well, maybe it's possible that the history of business cycles has changed a little bit. And even now Goldman Sachs, which a year ago gave a 60% chance of recession, just this morning comes out with a 15% chance of recession. I mean, it's just amazing how when you have a strong market, all of a sudden people no longer doubt there'll be recession. But now is a great time to work. It's when the economy looks good is that when you get a surprise recession. Economy looks good, so good that the Fed is tightening. So number one, sentiment. Number two is something I'm going to get in a minute, something called gap analysis, suggests the market will do poorly. Number three, of course, monetary policy. I mean, we're fighting the Fed. It's just so funny is that everyone out there, all these novice technicians or even fundamentalists say, don't fight the Fed, don't fight the Fed. And when I turned bearish last year, bullish, they said, don't fight the Fed. Now that I'm turning somewhat bearish, everyone's saying they're fighting the Fed, and I'm not fighting the Fed. I'm saying, listen, the Fed has been tightening for nearly 2 years. Let's not fight the Fed. It's about time to stop fighting the Fed. Anyway, we're talking about monetary policy, definitely. Interest rate action, you've seen the 2-year and you've seen the 10-year, you're tracing back up to previous highs. Interest rate action is not in favor of the bulls. There are major divergences amongst various markets we'll get to in a minute. And therefore, it allows for the gains of the 2022 lows to prove corrective. In other words, all these great gains we had since October of last year or January, may ultimately be corrective to the longer-term bear market. Of course, it was a bull market in itself. I mean, you're not going to argue that a 41% gain in the NASDAQ is not a bull market. You're not going to argue that a 8% gain in the S&P is not a bull market. Of course, it's a bull market, but it hasn't taken it to new highs. It might take it to minor new highs, but this doesn't. The fact that we're in a bull market till now is no reason to believe the bull market will continue. So I'm going to just say that we had a nice bull move, but it may prove to be what they call in technical terms a corrective rally within a long-term bear market rather than an impulsive rally. The best example to this would be the Dow Jones Industrial Average, even the S&P, from 1966 to 1982. As you know, the Dow at one point traded 5% above its 1968 high, but ultimately went down, 50%. So it was just a trading range in the Dow. Never really broke out to new highs, and that could be what you're going to see now. Another point is, when we're looking at the market, we're looking at the market in nominal terms. You adjust for inflation, you have to cut 12% off these returns. We have a 12% inflation rate going back a year and a half. So I say the S&P is up 28.29% off its lows. Well, over a year ago, inflation isn't 12%, but the reality is you have to cut the inflation numbers. So the market isn't as good as it seemingly seems. Now, people are arguing, how can you say that the market will not go higher? After all, the NASDAQ 100 is up 48.34%. We've never seen the NASDAQ 100 gain 48% in the bear market. That's just not true. Starting on April 4th, 2021, the NASDAQ gained 49% in the bear market rally. And starting September 21st, 2001, right after the 9/11 crisis, the NDX gained 52% in the bear market rally. So I'm not convinced that the current 48% NDX gain off its lows, intraday low to intraday high, is not a bear market rally. I'm not saying it is, but I'm not convinced that it's not. So let's look at some of the problems we're having in the markets. Fundamentally, although the Fed was raising rates last January, right here, but the real federal funds rate had been negative for the first 11 months of the tightening cycle. They really weren't. I think I did mention they really weren't tightening. They said they were tightening. It looked like they were tightening. Nominally they were tightening, but on a real basis, federal funds rate were negative for the first 11 months of the tightening cycle. That might explain why there was no recession, why the market was able to go up after the Ukraine crisis. It wasn't resolved. People realized we're not headed for nuclear war, which we thought we might be last June, a year ago June. So the point is that federal funds are now finally positive, getting positive rates. They're actually, for the first time in June, since this June, they're really tightening. So the tightening didn't start, last March 2022. The tightening just started here in June, number one. Secondly, so I say perhaps rather it was officially restrictive monetary policy at this point. Secondly, everyone's looking at gross domestic product, which has been booming, but gross domestic income, which doesn't look at product, it looks at the actual income, that has declined in 3 of the past 4 quarters. So maybe the underlying economy isn't as strong as it seems. I mean, I'm not the big economist, but I would say, the reality is that the economy has been weak and might get weaker. Rather than say it's strong, it's going to get stronger. Gross domestic income has declined in 3 of the past 4 quarters. Anyway, if the market is peaking here, which it may be, then this GDI might be forewarning a decline in GDP, because usually GDI and GDP work together. They correlate. This time, for some reason, GDP is headed higher while gross domestic income has been weak. So that's on a fundamental basis. Real rates, the inverted yield curve is now an inverted yield curve using real rates, using real 2-year, using real 10-year, using real 30-year rates, as opposed to using nominal rates, which on an inflation basis was not a real at a high level. So that's on a fundamental basis, things to look at. Another thing to look at fundamentally, or I'd say it's actually technically, is the following. The banking index, although it's not the greatest index in the world, meaning as far as its market cap, sometimes it fluctuates, but generally the banking index is what bottoms along with the S&P and NASDAQ. In other words, when there's a recession or there's a crisis, it's the banks that get hit the hardest.
Is it the KBW index?
I'm looking at the KBW, exactly. KBW. Generally, I'll give you an example. It's October 9th, 2002. October 9th, 2002. When the market peaked after the great 2000 decline. October 9th, 2002, the S&P made its final low, closing low. NASDAQ made its final closing low, and the KBW made its final closing low. BKX index, KBW. All 3 the same day. 2009, S&P bottomed on March 9th, and the banking index bottomed on March 9th, and the NASDAQ bottomed 1 day earlier on March 6th, trading day. So they all basically bottomed the same day. 2016. It wasn't a bear market, but it was a strong correction. And the S&P and NASDAQ bottomed on February 11th, and the banking index bottomed on February 9th, one trading day before.
I'm sorry, did you say, was that also true in 2009, March 2009?
2009, yeah, March 9th and March 6th. 2016, February 11th, February 9th. 2020, with the great COVID crisis, they all bottomed the same day, March 23rd, 2020. Now look what happened here. October 11th, 2022, S&P declines bottoms after a decline of 25%. October. December 28th, 2022, and NASDAQ makes its low after a decline of some 35%. And the banking index continues lower and lower until May 4th, 2023. It actually declined 24% below its October low. S&P bottomed October 11th, went up 13.54% to May 4th, 2023. While the S&P gained 13%, the banking index declined 24%.
Milton, we and our viewers can attribute a lot of fundamental reasons for that. A giant bank, one of the largest banks on the West Coast, failed.
Right.
And but you're just looking at it at a technical basis.
No. I'm looking. Listen, I started out as fundamentally for a technician. I just don't like to talk about fundamental stuff. But if you ask me, I will.
Yeah.
Something called the canary in the coal mine. I mean, this SVB is not just a crazy manager made a mistake. Let me tell you something I've been saying for years. I've been saying for the last 15 years. I'm saying the following: if you ever get a bear market in bonds, meaning interest rates move up, that's going to be a depressionary, deflationary phenomenon. Because most of the world's assets are tied up in interest-bearing certificates. Both banks, pension funds, endowments, retirement funds, all over the world, most assets are tied up in interest-bearing instruments. SVB was the tip of the iceberg. They were caught with their pants down. They didn't hedge themselves properly. So they had to expose the fact that they had all these assets that were underwater. But I'm not going to say you do. I'm not saying I do. But how many people out there in the retirement funds own 30-year treasuries over the last 10 years? How many endowments own? Who knows what the Nobel endowment for the Peace Prize and the Economics Prize? Who knows how many treasury bills they had? Who knows how many German citizens own bond yielding 0%? There's the deflationary crisis. I don't want to talk fundamentals because I don't want to sound like everybody else. The world's coming to an end. I like to stick to the technicals. But on a fundamental basis, there's the tremendous deflationary forces caused by the fact that interest rates are high, the long rates are high. I mean, you have no idea how much this is. And SVB is just a canary in the coal mine, tip of the iceberg. That's my opinion. So you can give a fundamental reason why, but you give a better fundamental why it's going to happen to many, many more banks, many, many more assets. And it's going to probably be a slow process, slowly, because we're able to hide it. Because something called mark to market and something called no mark to market. For some reason, the banking regulators say, if you own a treasury bond, yield expiring 30 years from now, or you own some other bond, a Disney bond expiring 100 years from now, you don't even have to market to market. Just market at its face value. Totally ridiculous. The market and the economy and the free market understands that there's tremendous deflationary pressures. And that's probably why. Let's stick to the technicals. But I'll just wanted to respond to your reason. Yes, that's the reason. The reason is because SVB. But the reason SVB collapsed wasn't because some managers were busy playing games instead of managing the company. Because they did what every other bank did. They bought long-term treasuries. Unfortunately, they didn't hedge it properly, and they had to uncover the weakness that all banks have.
Before I comment on that, I just want to say, so it sounds like you are bullish in a quite short-term basis, in the same way that from March 2007 to the fall of 2007, that was a bull move. But you think that the bull market could be close to any?
I'm giving the bull move the benefit of the doubt, 100% long, but I understand that the evidence I have is not that we had last January that we're headed for a big bull move. The evidence is most likely we're headed for a regular rally, maybe, but I did show you there's one indicator only signal during bull markets. I have to keep all these things in mind to balance it all out. Basically, what we do is we're long till we get a sell signal. We had sell signals in July. We were short. We got long. Maybe the sell signal will come in 6 weeks. Maybe it will come in 2 weeks. Maybe it will come a year from now and the market's up another 100%. And that's very easy to picture that, If central banks panic and start printing again, you have no idea how high this market will go. I don't think it's going to happen, but I don't want to try to predict the Fed. Let's get back. That's one thing. Let's see what else we've seen. That's why this market is different. I showed that the banking index. I showed that the NASDAQ has its weakest bull market gain ever. Let's look at something very simple. This is really very simple to look at. Let's look at the Russell 2000.
Wait, sorry, Milton. I just want to go back to your. I'm sorry. I know you don't like being interrupted, but like just the KBW index, as you said, it bottomed on May 4th, and since then it rallied 17% into late July. And then it's declined since then about 5%, but it's still up from that bottom of
of
May.
Course. Well, the S&P is up off its October lows. Everyone's up off their lows. The point is, this KB index, is down from 68% off its lows. Hold, give me a second.
And I think on May 4th or May 5th is when First Republic failed.
It actually gained 28.64% from intraday lows to intraday highs, and now it's pulling back. You could argue it's a pullback from the bull market. I'm not arguing that. My argument was just we have to understand why the banking index was weak while the rest of the economy was turning up. And by the way, the KBW the SVB crisis began in March, but the KBW index peaked on February 2nd, along with the Russell 2000 and the SP small cap, which are not banking indexes. They haven't. So we'll get to that. But you're making a good point. I don't want to harp on any one indicator. I'd rather get to as many as possible. Well taken on a fundamental basis. Listen, these fundamentalists who are saying no recession are going to say, oh, let's ignore SVB. But when they force a recession, they'll remind themselves, wow, SVB was a canary in the coal mine.
Big thanks to YCharts for sponsoring today's episode. Lots of exciting stuff going on there. They just launched a new functionality called Proposals. If you're in the investment management or investment advisor business, you need to check it out. It's got all the tools so you can communicate with clients and win new business. It's got a customizable report generator, custom talking points, compliance-approved messaging, and seamless personalization options for importing marketed collateral and firm branding. So it's going to make that communication with your clients, whether they're existing clients or new clients, very seamless. Visit go.ycharts.com/forward-guidance or click the link in the show notes to check out this new functionality, and you get a free trial. And if you use my link, you get 15% off your initial subscription, but that's only if you use my link. So remember it. Say it with me, go.ycharts.com/forward-guidance. I'm the one who has to memorize it. All you have to do is click on it. So if you're an advisor, YCharts communication tools and proposals, it's got you covered. It's going to change the game. If you're an investor or financial researcher, such as myself, that's how I use YCharts every day, looking through the data. It makes it so seamless for me. And I think that many people watching this now will benefit from YCharts. So check it out. Thanks. Let's get back to the episode. The total amount of loans in the U.S. has been flat since January, February, and that economically, is not a good leading indicator. Milton, I want to ask you, early March when SVB failed and you had all these bank failures, very worrying for folks such as myself, paying close attention to the banking sector. And I would have suspected that the S&P 500 and stocks would have had a challenging time. They had a challenging time on that Friday and maybe on that Monday, but actually from March into late July, it was typical bull market action, and it was also very low volatile and very expected. There were no dramatic, 2%. The pullbacks were extremely small.
I'm so excited that you mentioned that because
was there anything about that market that indicated to you that it was a very healthy rally that would continue because it was just grinding higher?
It's so interesting because we didn't plan this in advance. That's actually a loaded question. That's exactly what I wanted to talk about.
I'm glad.
Number one, the semiconductor index, right? The Philadelphia Semiconductor Index had a series of gaps. It had an upside gap on May 25th, upside gap on May 26th, upside gap on June 13th, upside gap on June 30th, upside gap on July 27th, downside gap on May 31st, downside gap on July 12th, downside gap on July 20th, downside gap on August 2nd, downside gap on August 11th.
What is that again? A gap?
Upside gap. A gap is when the market opens higher than its previous day's high and never trades below its previous day's high. I challenge you to find a period in history of the stock market where you said this many upside gaps and downside gaps. That's in the NDX. Upside gap June 30th. Upside gap July 12th. Upside gap July 13th. Downside gap July 20th. Downside gap August 2nd. Anyway, the point being is when you see a lot of gaps, it's a sign of not a healthy market. You're right. There were not many pullbacks. But the reason there were not many pullbacks is everybody was finally turning bullish. You know why they turned bullish? Because look how well the SP did while the BKX index was collapsing. They turned bullish for technical reasons, what they consider technical reasons. I mean, and then they say, well, there won't be a recession. But the reality is the kind of action we saw was the kind of action you see during a topping process, where people are coming in, buying stocks, pushing them up, creating gaps, emotional upside, emotional downside gaps. Now, I want to point out that you remember the great bear market that began on March 10th, 2000 in the NASDAQ? Whoever remembers that? It began on March 9th. The peak was March 9th, March 10th. One day after that high, the NASDAQ had a minor gap to the downside, but it was unfilled gap to the downside one day after the high. Very many bull markets end, mostly in commodities, but even in stocks end with a downside gap 1 to 4 days past the final high. You saw it on September 20th, 2018. You saw it on February 24th, 2000. You saw it on August 22nd, 2022, October 16th, 1989. But right now you saw downside gaps 1 to 4 days after the highs. Yeah, you had highs in July 27th, you had highs in July 30th, and you had gaps right after that. You had the stocks gap down on August 2nd and August 8th, August 11th, and the NDX gap down July 20th. It's higher as July 19th. So the point I'm making is, while it looks superficially to people who don't analyze the market with a fine magnifier and just looks at superficial numbers, yes, it looked like a nice orderly rally, but it wasn't orderly rally at all. Secondly, I mentioned put call ratios. Let me get to that in a moment. I know I mentioned the indicators, but I want to mention the other put call ratios. Here it is. The 10-day put call ratio was lowest of the year. I mentioned that it was highest in 6 months back now in late August, really, right? But 10-day put call ratio was lowest in a year on June 15th, June 16th, June 20th, June 21st, July 10th, July 11th, July 13th, July 14th. 8 times until the market top, you had the successively lower 10-day put call ratios, each one lowest in the last year. Now, that's not a regular occurrence through an orderly market. Just to point it out, at the 1987 top, there were 9 days of 10-day put call ratios lowest of the year until the final top. In the year 2000 and 2007, there were 3 days in which the 10-day put call ratio was lowest in the year. And I did some more analysis.
And so sorry, but the put call ratio of put
meaning
to call.
If it's
and
lowest,
if it's low,
meaning betting the market going higher. A low ratio means
people are
the
not
betting
hedged for a
market.
market. So if there is a crash when the put to call ratio is low, people are caught with their pants down. Whereas if people are buying so many puts and then the market crashes, they make money. They're hedged.
Right. That's true, and it's also sentiment indicated. Why are people betting the market's going higher? All of a sudden, it's July 14th. Nasdaq's already up 48%. Why are they buying calls now? Can't they think there might be a correction? No, because there's no longer going to be a recession and inverted yield curves mean nothing anymore. It's interesting. It's psychology. Anyway, I looked something else. We saw the 10-day put call ratio at its lowest in the year 8 times in the last 20 days. When did you see that before? We only saw that once before. On January 12th, 2020, 21 days before the market peaked, it peaked 1.7% higher. And currently, the market peaked 1.85% higher in 11 days. That's another But the point I want to make, I don't want to go through intricacies. The point is, it seemed like an orderly rally, but it wasn't. Number one, there's a series of multiple gaps to the upside, gaps to the downside, number one. Number two is everyone's buying calls relative to puts because they're sure the market's going higher. And on a sentiment base, as you know, everyone gave up on recession for some reason. All of a sudden, the Fed continues tightening, and interest rates are now find real rates for the first time since they started tightening. And all of a sudden, everyone is saying no recession. Goldman Sachs, a year ago said a 65% chance of recession, now goes down to 15% chance of recession. You have to realize when people give percentages like that, it's very difficult because you can never prove them wrong. You understand? Because if the market if you have a Great Depression beginning tomorrow, let's say it began already, these analysts will just say, well, I gave a 15% chance of the market of recession.
And there's a sample size of one. The die is only rolled one time.
You have to really, as a trader, I also use the probabilities. Probabilities is all we have. But can you act on the probability or not? If he's saying, since it's only an 85% chance of recession, he says, therefore, short the bond market or do whatever and buy stocks, then you could prove him wrong because the stocks go down. But just to say 15% and not giving any action based on it doesn't help anybody. It maybe helps people in their career to say this, but it doesn't help anybody who's a client trying to watch it.
And I think there is an institutional bias of if someone has been bearish for 7 months into a rally, that's looking bad for them and their firm, and so they have to switch positions, even if it is now the time to get bearish. And so, Milton, I want to explain a few things. First of all, those two phenomena you said, lots of upside gaps and downside gaps, as well as put to call ratios. I wonder if that has something to do with the rise and proliferation of zero data expiry options. No?
This question was asked me back last November. Remember last November we had everyone was buying puts, and I said this is another piece of evidence that the market's going higher, and they're actually at the bottom. No, listen, it doesn't matter if it's the 1-day options or the 30-day options or 30-year options. People buy puts when they're bearish, and people buy calls when they're bullish. It doesn't matter the expiration. It doesn't matter proliferation of any options. We're talking about a ratio. They could either buy calls or buy puts. If they're buying more puts than calls, it's because they're bearish. If they're buying more calls than puts, it's because they're bullish. This doesn't affect it at all. It's just a mistake. It's just an excuse people are making. The reality is that people who are buying calls are buying because they're bullish, and that rally off the May lows in the banking index into the July highs. So proliferation of call buying and of gaps to the ups and to the downside, meaning very emotional trading. That's a good question.
I just want to say one thing, and I I would say I am not an expert on options, but I think that traditionally options are created from nothing, but clients buy them. So if a put ratio is high, that typically means clients, are long puts, and people who, market makers are short puts. But I think now actually clients are selling a lot of puts. So if clients are selling puts, they actually could be bullish.
Yeah. Oh, yeah. But we're not looking at buys only. We're looking at buying puts and buying calls only.
Okay, buying.
We're not looking at total volume. Looking at volume of the buys rather than it's adjusted. This is adjusted for the buying and selling. Anyway, let's go to another point. Another reason to doubt this bull market. Now, this is, again, we said the market's going to rally. We had buy signals, but there's something also very, very missing from this bull market. Very, very significant. To me, it's significant because I'm a technician. It might not be significant. It might not be significant to you. It might not be significant to people watching the show. But let me tell you something. Since 1962, there were 2, 4, 6, 7 bull markets in the S&P 500, and I'll define the bull market. Bull market meaning that the S&P declined at least 25%.
7 bear markets.
7 bull markets that began after the market declining 25%. In other words, the bull markets that begin after the market are 19% or 18%. But there have been 7 bull markets that began, 8 bull markets, including the current, that began after the market declined 25%. Now, there's a phenomenon that we've noticed as a technician that takes place early in bull markets. And I will now take a 1 minute to go through this phenomenon. The 1962 bull market, day 6 after the bull market, the 5-day rate of change in the S&P was 8%. 1970 bull market, day 5 after the low, the 5-day rate of change in the S&P was 12.33%. 1974, day 6 after the low, the 5-day rate of change was 14.11%. 1982, day 7 after the low, the 5-day rate of change was 11.5%. 1987, day 10 after the low, the 5-day rate of change was 12.33%. 2002, day 5 off the low, the S&P gained a 5-day rate of change was 10.7. And in 2020, day 5 off the low, the 5-day rate of change was 17.39%. Currently, day 21 after the low, the greatest rate of change we've seen in this move was 6.35% in the S&P 500.
Which low? June 2022? October?
12th, 2022,
yeah,
which was the low, October 11th. It took 21 days till you found the 5-day period where we had some sort of a momentum move. And now all it was 6.35%. So most bull markets see gains of 10, 11, 12, 13% within 6 days of a low. We saw 6% within 21 days of a low. Meaning there's something missing in this bull market. This is a characteristic of a bear market rally. Some momentum is missing. I just want to point that out.
But we've had such a vigorous rally since then. I remember being on the opposite side of this point, Milton, in January. I think you said something like, and maybe you were talking about the Chinese market, but you said that the stock market's up. We had a vigorous thrust, although I don't know if that's technically a thrust. And I said, but isn't that typical of a bear market rally when you have a huge thrust in a few days? And you said, actually, no, it's only on one day. Like the biggest one-day rallies are in a bear market.
I actually reviewed the previous. We did discuss this. The signals are not based on 5-day rates of change. The signals we were talking about were based on a deep thrust, volume thrust, and so on. I actually did point out, even in that interview, that the 5-day rate of change was bothering me even then. Back in January, I actually pointed this out. This 5-day rate of change was bothering me even at that point, and certainly bothering me now. That's another reason to doubt the bull market. Now, another type of thing that we're treating people bullish, we really shouldn't have. You said there was a orderly rally into the July highs. But there's also people saying it's very strong momentum into the July highs. Now, what we did is we look at history into July 13th. The S&P had 4 days with the following gains. Starting on July 10th, first day 10, on July 10th, they gained 0.24% in the day. July 11th, they gained 0.67. July 12th, they gained 0.74%. Then July 13th, it gained 0.85%. 4 successive days of higher percentage gains in the S&P. It's a very rare occurrence. You would think that this is a very bullish occurrence. Again, 4 successive days where the S&P is having a greater percentage gain, 0.25%, 0.75%, 0.75%, and 0.9% in a row. Well, this phenomenon, not necessarily bullish, because I look back in history, and I see that in May 1928 it led to a 9% decline. In May 1949 it led to an 8% decline. And in September 1962, it led to a 9% decline. In October 69, it led to a 27% decline. In 77, 14%, 1990, 19%. And in modern history, on January 28, 2009, it led to a 22% decline. So this so-called momentum is not positive momentum at all. It can lead, and I say it's not an indicator saying the market has to go down. I'm just telling you, when people assume just because the market's acting so nice, it's going to go higher, there's no reason to assume that. Something else we look at is 5-day net upside volume. And what we do here is we look at the New York Stock Exchange, we look at 5-day volume, we look at what percentage of volume was on the up stocks, what percentage of volume was on the down stocks on a 5-day basis, and we do a ratio of that to the total volume. So the 5-day net up volume as a percent of total New York Stock Exchange volume was greater than 45%. Now in this place, I have to point out that going back to 1957, now prior to that, it's all over the place. 1957 on, this has never taken place in a bear market. We had a reading above 45%, and it happened numerous times. Look here, it happened maybe 30 times since 1957, or even more. It never occurred during a bear market. However, it has occurred in the last rally in a bull market. Okay? In other words, it never occurred during a bear market rally, but it has occurred in the last rally in a bull market. So let me give you the data on this one. 5-day net up volume of 45%. You saw it in 1962, and the market declined 9%. And in 1970, it declined 8%, 71, 9, anyway, so on and so forth. You saw it on August 11th, 87, the market declined 32%. The point is, although you never see this in a bear market, you do see it before corrections in a bull market, and you also see it at the end of a bull market. For example, you saw it in 1987 at the end of a bull market. You saw it in 2011. 2011, you saw it at the end of a bull market. Remember the April to July 2011 top where we had the financial crisis in Europe. The market was estimated down 19%, DAX was down 36%. You saw it right at the top there. So again, this is something to worry about. You can argue, well, do you always face the bull market? That's correct. But if there's other evidence of a bear market, this is a reason to say that this at least suggests that a bear market is possible, or the end of a bull market is possible.
Milton, I want to throw something at you, which is I don't know if it was during July, but there was either a record set or close to a record set for the number of consecutive up days in the Dow Jones or the S&P.
Are you reading my notes?
No, I'm not. I promise I'm not reading my notes.
Russell 2000 was up 14 or 17 days into July 19th. 14 or 17 days. People aren't recognizing that on September 1st, 2000, the Russell 2000 was up 14 or 17 days as a secondary peak in that bear market. In other words, the Russell is a lagging indicator, as you know. The Russell 2000 is way below its highs of last year, and it's not even above its August 2022 highs. It's not even above its February 2nd, 2023 highs. Back in 2000, you had the same story with the Russell. Let me give you the exact data. Might as well. I'm surprised you bring this up. Russell Index GP. Let's go back to the year 2000. Listen to this. The Russell 2000 on September 1st, 2000 was 10% off its highs of March 2000. RTY index GP. Let's see where it is now. Current July peak, which was on right. The Russell 2000 was 17.9% off its highs of 2021. Right. So then it was 10%. In each case, the Russell gains for 14 to 70 days into a high, immediately turned down. So yes, it's not a bullish phenomenon. It's more of a bearish phenomenon.
Not a bullish phenomenon.
Okay.
And in bull markets, it doesn't occur that often, such as 2009 to 2019.
Streaks and gaps and other phenomena in technical analysis are not randomly distributed. Doesn't mean they only happen at top, they only happen at bottoms, but an indicator that happens only at tops and bottoms is also a significant indicator. Let's assume this also takes place early in bull markets, but also takes place end of bull markets. So you have a barbell here. Half the time it calls the top, half the time it calls the bottom. What's it most likely calling now? Russell's up. Nasdaq is up 48%. Russell's lagging. S&P's up 31%. Is it most likely calling a new bull market, or most likely calling the top of a bull market? Let's say it's a non-really distributed data, but
how could this call a bottom if we've had such a big rally?
Exactly. How can it call a bottom? Right. Exactly. So this type of momentum, which would be good if it's coming off a low, but it's not good coming into a secondary peak. So I've been talking about, so this is, I don't know if the big picture here is we were very bullish. You still have to give the benefit of the doubt to the bullish case because we just got buy signals in August, but those buy signals are not bull market signals. Those buy signals are basically can just tell you that we'll have another, 5, 6, 7, 10% rally before the final high. We saw these gaps. You saw that, you see now everyone's looking at no recession when it's most likely. Now it's more likely now we'll get a recession than any time in the last 2 years. You have deflationary forces in the bond market, which people aren't recognizing, which is probably why you have the Federal Reserve lowering the money supply, which is really, really a killer. It's a killer for inflation, but it's a killer for stock markets. Forget about the real interest rates. Money supply is what goosed up these markets for decades. And if the money supply decline is going to bite, it's going to hit very, very hard.
And the money supply is M2 or just the level of reserve.
The Fed is buying treasury bonds, which means all these $65 billion a month that was in people's hands has now disappeared. That's all you have to know. Money that was out there freely floating has now disappeared. It's gone to a black hole. It disappears. It doesn't go anyplace. The Fed
reserves have bank reserves, liabilities of the Fed, assets of institutional investors and banks. Really, those have declined, and correspondingly, bank deposits, which are people's money, that's declined as well. So money has gone to the black hole. Correct.
And real money, which is assets, for example, people consider the treasury bond as money because it's not considered money in the money supply, but it's considered money because I can just borrow against my treasuries. I can't borrow now that it's underwater. I could borrow, but I can't borrow as much as I used to be able to borrow. I can't borrow off face value, that's for sure.
Yes, but the Fed set up a program. First of all, I just want to totally agree with you that you should count treasuries as money supply, and if you do, the money supply hasn't gone down nearly as much. Maybe it's even gone up, and those losses are real. You're right, but the Federal Reserve set up a program for banks to borrow against those at par.
That's why I say if it's hard enough to predict the market. To pick the Federal Reserve, you really got to be. I mean, if they'd be an honest Federal Reserve, we'll definitely have a recession. You don't know how honest they are. They may print. I want to discuss something which my clients are aware of. I started last interview with this, but I saw some of the comments. People said I turned it off as soon as he talked about this, because there's the cycle work we do, which is not conventional technical analysis, but it was pioneered by Paul Montgomery, was one of the great market analysts. He's the one who invented the headline indicator and so on. Various cover story indicator. The headline indicators on Time Magazine, Newsweek, and so on. Economist, and there's something called cycle days. Now, I'm very perturbed by the fact that people don't like to listen about cycle days, but they talk about seasonality. I mean, every analyst out there, whether it's fundamentals or whatever, September's the worst one for the market, and
January's the best one. September's
then October, you get crashes, and they talk about the Christmas rally, and they talk about the summer rally. All these are basically cyclical solar phenomena. The calendar is based on the sun, and if there's for some reason the markets go down in September, it has something to do with the 10th month in the solar cycle. It's really.
Milton, can I ask you about, so for solar indicators for commodities like natural gas, when it's during the winter, people want natural gas to heat themselves, and during they want oil in the summer because they're driving,
right,
and flying on planes. Yeah, that is a real phenomenon. And then,
but that doesn't work. That just doesn't work. You think the suppliers of the commodities aren't aware of the fact that
no. It does. So it's already priced in. It's already priced in.
It's all priced in. Exactly. That's not a solar phenomenon. That's the fact people need heat. It's not a solar phenomenon or a lunar phenomenon. Means that the sun or the moon have an effect on the emotions or the psychology of people, which cause them to buy things they shouldn't buy or sell things when they shouldn't sell, or to panic. Let me give you one of the greatest reports written about this. Won an award for the CMT, which is the MTA, the Market Technicians Association. I think it goes back to the late 80s or early 90s. A fellow named Chris Carolyn wrote a report on the spiral calendar. And he showed how the great crashes in history all took place in October, but it wasn't really October. It was actually the 26th and 27th day of Tishri, which is a 10th month in the lunar calendar, in the Hebrew lunar calendar. And he shows even before there's any communication between Europe and the United States in the 1800s, there's no telegraph, there's no telegram, there's no internet, nothing. Crashes took place the same day. So what was the phenomenon that caused these crashes to take place the same day? And it's an amazing, it's just his report, but the reality is that there are certain cyclical forces that affect people's emotions, and the stock market movements are basically dependent on people buying and selling. And as you know, it's an emotional game. I'm always saying this because people are claiming that October is a negative month. It's not negative. It's only negative when there's cycles involved. And we have a whole slew of cycles beginning on September 14th. Not every October, not every September has these cycles, but now happens to be, it's a convergence of solar and lunar cycles together in this September, this October. So there's more likely to be buying, selling, or maybe even panic buying during the next 2 months in this year than it is in most previous years. So I'm just adding to what everyone else is talking about. If the people, the talking heads at CNBC or Fox Business News or Bloomberg can talk about, we expect a week September or a week October, I can say, well, my work coincides with that based on cyclic factors, which my clients are aware of.
I said something, you said it's not a solar signal. I would say if you want natural gas because it's cold outside, that is because of the sun, right? So you're saying it's influencing people's emotions. Likewise, there used to be an effect in the 1920s, maybe a fundamental effect of during the harvest, all the farmers have to draw upon credit from the bank. So that's drawing gold from the Wall Street banks, so they don't have money to speculate. So the stock market goes down. So those are fundamental forces. You're also saying this thing about how solar and lunar affects the mood. I don't know that at all, but I'll also just introduce the concept, Milton, that it's possible that all of these phenomena could be random. Like if you ask, if you take a room of 1,000 people and they have to flip a coin or play rock paper scissors against each other, and then there's 500 people, and then there's 250. The one guy at the end, he's going to have won 10 rock paper scissors game in a row. So yes, September historically bad month, as the analysts on TV say, and September of 2022 bad, stocks were down. September of 2021 stocks were down. September of 2020, so 3 years in a row. That is something, but again, it could be random. So I just want to introduce that for the audience.
Yeah. Well, we test it against randomness. We did statistical testing. We don't say this is a bad month, it's a good month. We get specific dates in which markets return. So what we do. I can't explain it over this show, but what we do is I'm just trying to say we're not the typical seasonality. Now I know there was a great market value investor named Philip Carre. He ran the Pioneer Funds. He wrote a book in 1920s called The Art of Speculation. He was Benjamin Graham's He was a much far better, greater value analyst than Benjamin Graham was. And he was always perturbed by the fact that markets go down in September. And he came up with a theory. His theory was people have a long vacation in August. They finally get back to work September. They start rethinking their business. And they realize at that time, things aren't as rosy as they thought it's going to be. And then so on and so forth. That's why they sell stocks. Everyone had to come up with a theory. You come up with whatever theory you'd like. So the point we're saying is cyclically, and the next few months are kind of cycles coincide with the seasonality cycle. Let me give you some historical evidence to this kind of stuff, just to give you some idea. Okay, I'm going to talk. We have what we call our cycles Montgomery dates, because these cycles were discovered by Paul Montgomery. The cycle, decades, centuries in advance, because it's based on lunar cycles. So let me give you some example of what we've seen during these cycles. For example, the S&P peaked on January 4th, 2022. That was a cycle date. The S&P, the 10-year government yield peaked on October 21st, 2022. That was a cycle date, and it declined from a yield from 4.33 to 4.24 to April 6th, 2023, which is also a cycle date. The Brazil stock index bottomed on March 23rd, 2023, a cycle date, gained 19.6%. Gold, for example, gold peaked on May 4th, 2023, after 27% gain. That peak was on a cycle date. Silver peaked on May 5th, 2023, after a gain of 48%. That was a cycle date.
Also the day, I think, or the day before, after a bank.
Well, May 4th, 2023, the spike low in the KBW bank index, that was a cycle date. We went long the bank index at that day because it was a cycle date. Its last minor high in April 19, 2023, that was a cycle date. Let's go back to Bitcoin, because since Bitcoin doesn't trade on fundamentals, it trades on emotions. Bitcoin at this point is the asset, in my opinion, I've seen it trades more on cycle dates than anything else we've fine. Gold used to be the one that trades most on cycle dates, but it's become Bitcoin. Now, let me just go through Bitcoin. Bitcoin had a climax top December 18, 2017, tuition declined 70%. That was a cycle date. Bitcoin peaked on July 25th, 2018, declined 61%. That was a cycle date. It bottomed on June 29th, 2018, and gained 46%. That was a cycle date. December 24th, 2018, it peaked. After gaining 43%, it was a cycle date. Then it declined 21% to the next cycle date. May 2020 was a cycle date, but in that case, it was a very minor pullback. On November 30th, 2020, it was a was a cycle date, and from then it gained some hundreds of percent. I'm looking at that. Anyway, basically, June 1st, 2022 was a cycle date. It declined 45%. So these cycle dates that we use, it's just a supplement to the other work that we do. I just want to point out that anyone who's interested that the next 2 months are highly cyclic. And if we're going to get a great recession ahead or a recession ahead, unexpected, if you get a market collapse up ahead, unexpected, and people are going to attribute it to the Fed and so on, I said, well, if you're not a crash because of the Fed, it should have happened a year ago, based on typical fundamental analysis. But should it happen here, I think it's the cyclic forces that are going to cause it. In any event, I'm just pointing out that we should expect cyclic-like action over the next 2 months, meaning emotional ups, emotional downs. Considering where we are in the market cycle, I think it's most likely to be a down than an up. I hope I wasn't getting too off base with this kind of analysis, but this is the kind of thing that our clients see, and some people are very, very fascinated and actually trade based on it.
How many Montgomery dates do we have over the next 3 months? And can you describe the effects on a Montgomery date? Is it a turning point?
Turning point. It's turning point. Very rarely is it an acceleration. Very rarely is it an acceleration. Let me give you the dates. Here we go, Montgomery. You guys can look up Paul Montgomery because I was a sort of a student of his, so I have all his works and so on, so I'm able to study it. The cycle dates coming up: September 14th, number 1, September 29th, number 2, October 14th, October 28th, November 13th, November 27th. The two most important ones are October 14th and October 28th, meaning because they're what they call a major cycle as opposed to a minor cycle, but any of them could turn the market. So you have 6 of them coming up over the next 2 months.
Got it. Thank you. Milton, now let's turn to China. You got your timing on China, if I remember, was very prescient in October of last year. I believe you got bullish on China the day that the stock market bottomed, which turned out very well from October till January, I believe is when the market peaked, or maybe February. But the Chinese stock market has faltered and hasn't been crashing, but it's been definitely faltering and is lower than it was in January and February. And I'll say just the Chinese economy, which was expected to rebound as the economy reopened, that's been kind of a somewhat a flop, as well as the Chinese government's stimulus to the economy. So what's your current outlook on Chinese equities and why?
Okay. First, Quilly, we have to point out what you point out. We're talking the bank index. Even though Chinese equities have been faltering since they peaked on January 27th, they're still up 29.04% off its intraday low on October, October 30th or so, October 27th, October 24th. So it's still up 29%. So you can argue that the markets fluctuate. If you bought at the lows and you held on, you're up 29%. But that's not so good because it gained 60.7% into its January. That's kind of strange. You're right. It bottoms and it gains 60%. It's not typical bull market action. If it's a bull market, you should have seen it continue higher from here. I'm thinking that possibly if we do get a bear market in the United States, the fact that China peaked in January, the fact that Hong Kong peaked in January, the fact that the Russell 2000 and the S&P small cap and mid caps basically peaked in February, the fact that the fact gold peaked in May, I think might all be leading indicators, to the fact that the market has very, very weak legs that it's standing on. The S&P and the Nasdaq have very weak legs because things are sort of falling apart. This is what you sort of see at market tops, where the liquidity that supposedly dries up all markets, all of the liquidity is drying up, and only a handful of markets, a handful of stocks are moving up. So I'm negative. I can't say I'm positive. I was positive at the lows. I'm very surprised by the action, by the fact that it gained 60% and it's pulled back. It hasn't been able to maintain that momentum. So if you have to give me yes or no, I have to say I'm bearish on China. I'd have to say at this point I'd be bearish on China. I have no position in China at this point. I don't have the confidence either way, take a position in China. I had much confidence at the lows, but I have no confidence at this point to take a position in China. I can't say that I'm bullish on China for the short term. I have to say if I have a choice, I'd say I'm negative.
Thank you, Milton. And so if I were to summarize your views on U.S. stocks, long term you are cautious, and you actually think this could be the end of a bear market rally, the end of a rally. But short term, you're still 100% long. Yeah. So tell us, what would it take for you to become bearish, and how long do you expect to be long? Is it, I'm bearish for 2 more weeks, and then I'll see my indicator, and then I'm going to switch from 100% long to 20% short or something like that? Or do you expect to be long for a few more months or even longer than that?
Based on the buy signals we've got, most of the buy signals we've got are not long-term buy signals. Most of them just tell you get a rally ahead. So based on that, I could say anywhere from 2 weeks to 2 months is where it would be long. But basically what I say is I'm long till I have evidence to get me short. Usually the evidence is with the indicators. The indicator, I get an indicator that turns negative or a gap down, for example. But sometimes you're forced to get out of your position because you're losing money because the market declines. So let's see how this rally, this rally hasn't been the strongest rally off the August lows. None of the markets have made new highs above the July highs. So I say at this point, I say we're long until we get a sell signal. I have no evidence it'll be a long-term move. I'm going very contrary to what I'm hearing by these economists and talking heads. I think there's more evidence now that there's a recession ahead than less evidence that there was previously. I think they called it all wrong. And guess what? I just saw this today on Twitter. You're not going to believe it. Remember the last interview we had? I told you we had the recession. We had two quarters of GDP. I said, maybe you're right. Maybe there will be a recession. But we had it already. Now the market's taking off. Just today on Twitter, one famous analyst, I don't think it's right to mention his name, but you're going to see it. The guy's been on your show. He's finally saying, and he's been calling for recession, and he's finally saying, well, maybe we've seen the recession already because we had 2 quarters of declining GDP. You'll see it on your Twitter feed. But the point is, I think now's the time to worry about a recession. Really, if you're going to worry, now's the time to worry, is what I say.
Yeah. So, Milton, your call and your reasoning in January that the short-term recession fears would not play out, with the benefit of hindsight, objectively, that has played out well. I will say, I've talked to economists who say with 100% confidence that the NBER will not declare what happened in 2022 a recession, because even though it was 2 consecutive quarters of quarter-over-quarter negative real growth, a lot of strange stuff that I'm not going to pretend I understand what's going on with the inventories, as well as recession is a broad-based decline in industrial production, employment, other factors. And so that 2022 was not a recession, even though the kind of textbook definition, it was a 2 consecutive quarters that the NBER wouldn't categorize. And I also just say on the yield curve, I, alongside many others, got caught up of, we have an inverted yield curve that is bearish and that's bad for the economy. And it is, but with a lag. So when the yield curve first inverted, I think in the spring of 2022, the inverted yield curve can exist and the stock market goes up. And actually that often is the case up until a point, up until 12 to 18 months. And we're getting at that lag point. So I think what was wrong to worry about in a year ago or in January is now maybe right to worry about.
And again, then real rates were still negative. Now real rates are positive. The real curve has more of an effect. Yes, and listen, the economy, the NBER, as they say, the Federal Reserve is just a bunch of people, and the NBER is just a bunch of people, and people make mistakes, and they could label whatever they want. I see many great technicians I've studied from who point out that it doesn't really matter if it's a recession or a slowdown. But that inflection point in the economy is what causes the bear markets. And, it could be that, let's not label it a recession, but you have to label it a slowdown. 2 quarters of GDP decline. It got to be labeled something.
I'll call it slowdown.
Right. Yeah. So that slowdown caused the decline last year, along with the war in Ukraine. Now we have a great bull move. And the next decline will be caused by a real recession and real trouble ahead, maybe banking crisis. I mean, I don't want to project it. And as I say, we are long now. I really should focus on being long until we have it getting short. But the market clearly, listen, the Russell actually peaked in August of last year. Benefit of doubt, let's say it peaked in February. Its returns, I think, are 75% lower than the median return of any bull market in history in the Russell 2000. Its return to date, or if its lows, is 75% below the median return of. I think it's just an amazing thing that so many markets are so weak and so many individual stocks are so weak relative to the S&P and the NASDAQ. And things are very, very different. And with the kind of action we saw in June and July, with the up gaps and with the political ratios and with the Federal Reserve aggressively tightening, at this point you can say they're aggressively tightening, I think it's fair to say that although we're long, we're worried that we may get out very soon and position short again.
And the Russell performing not nearly as well as it normally does in a new bull market, that ties into the point of breadth, and it ties into the point of what are the stocks that really are holding up this rally. And I mean, the point has been made all the way up by people who have been wrong, but it's Apple, it's Microsoft, it's Tesla, but it's really NVIDIA. It's these Magnificent Seven stocks that, and people say, if you take out if it's the S&P 493 and you take out those Magnificent Seven stocks, the returns are much more pedestrian, maybe even negative. I don't think actually negative, but Yeah, but is that a sign of a healthy market, one in which it's these 7 mega cap companies leading the market higher?
I was never troubled by that because in my analysis of bull markets, there's always a leading group. So if it could be 7 stocks, it could be 30 stocks, but that's the nature of capitalism and that's the nature of the market. It's that the handful of stocks lead the market up.
At the beginning, you're right. You're right. But 9 months into the bull
Oh,
move,
right. That's it ends
yeah,
in narrow. You're right. Bull markets end with narrowness, no questions. But I'm saying it never doesn't bother me to see narrowness. It just bothers me when you see narrowness along with other things you're seeing at the end of this move. Then it doesn't bother me. But narrowness itself is not something you can act upon. Let's put it that way. Okay. Narrowness is not a reason to be out of a market. It's narrowness combined with bullish sentiment, combined with Federal Reserve tightening, combined with various aspects like that, with other markets lagging. Not we know with China having peaked 6 months ago, Hong Kong having peaked 6 months ago, Treasury yields double topping with the previous highs. That together with the breadth it gives you more reason to worry. I don't have any actionable signals based on the narrowness alone.
got it. So if in January you said I have 60 plus buy signals and 0 sell signals, what is the what does the arithmetic say? How many buy signals do you have now, and how many sell
My
signals?
buy signals are all stale. Remember, most of the buy signals go back to October or January. I have some in May, some in May, but they're basically stale.
You have a few August ones, right? August 28th.
August, but the August were the short-term signals. They don't tell me a bull market's ahead. The short-term signals still don't be short now. Wait for a better opportunity to go short. They're not the kind of signals where you say pound the table, we're up another 15% for sure. No. 4%, 5%, 6%, 8%, you don't know, but you don't want to be short when you get these kind of signals because who wants to sit through an 8% or 10% gain when you're short? So we'll see, one step at a time.
Got it. So all of your buy signals are stale. What about sell signals?
The market patterns, the sell patterns are not stale at all because you still have the downside gap 1 day after the high, 8 days after the high in major indices. You still have the put-call ratios at multi-year lows as the market is rallying into the July highs. So these things are still there. Sell signals, even this buy signal, the market is still not traded above its July highs. So there's far more weight to be played on the sell side at this point than on the long side, even though my last signals were buy signals. This is very complicated, see, because in order to understand what I'm doing, you have to understand our process. Our process is you buy at the buy signals, you sell at the sell signals, regardless of whether it's a long-term buy signal or short-term buy signal. And you keep on the lookout we're on the lookout for the cycles ahead. We're on the lookout for the fact that since there's so many divergences and since the market is internally so weak, that you could have a surprising top of the evidence for that. The evidence may be put-call rates come down again. The evidence may be a decline. We don't know what the evidence will be.
So, Milton, sorry, just hold you to, but how many sell signals do you have now that are active?
I can't give you a number. I just tell you the pattern of the market into the July highs was what you see at a bull market peak. That's all I can say. Or at an area of a bull market peak. If the S&P makes a new high, 2% above its July high, that's fine. If the NASDAQ makes a new high, 2% above that's fine. Listen, you saw. There's so many things you see technically. I can't discount them. People are aware of that. Remember that day when NVIDIA came out with that good news? I think that was the day. You had a big reversal pattern on July 27th. The market gapped to the upside. After previous series, gapped to the upside, turned down and closed down. The S&P was down 1.70% from its high to low in the day. That marks the final intraday high of the S&P. These are the kinds of things you see at market peaks. So you have that pattern at the top. The people give you terminology, candlestick terminology. The pattern into the July 17th high was a pattern you see at market peaks. And right now we haven't surpassed it. Now let's just give you an example. Let's just say the Russell gains from where we're at today, currently, down pretty big today, I see. Let's say it goes back. All right, yeah, down big. It's another 5.91% for the Russell to get back to its July high. So maybe you get another 5.8% or 5%, and then you decline. I don't know. But listen, today's action is not nice action. Russell's down 1.5%, but we're still above the August lows, and our indicators told us there should be rallies off those August lows, and we're long at this point, not pounding the table.
So what are you the most bullish on out of, and I'll throw a handful of asset classes at you. Emerging market stocks, you can pick a particular region, European stocks, international stocks, gold, bonds. Last time January, you were bearish on bonds, and relative to stocks, that has aged very well. Bonds were either they've either sold off, or if they've rallied, they've rallied 1/40th as much as stocks. So what in the asset universe are you bullish on or bearish on?
Okay, based on pure technical analysis, pure technical analysis,
Yeah.
I'm bullish on the banking index.
Okay. Yeah.
On pure technical analysis, you had a climax low in May, with all the classic headline news at the same time, all the classic, pessimism. So, you had total classic bottom. So if I had to choose an asset, but I would probably say that since I think if we have a decline, it'll be deflationary decline. And since it's a deflationary decline, there's really very little you can do to save yourself. I really can't pick an asset that I'm bullish for the long term. Now, for the long term, you have to be bullish on stocks for the long term. You have people out there building companies, making money, but we're talking sort of trading 6 months out. Right now I'm 100% long. It's all you have to know.
Yeah.
You got to be, but we're traders, and I can't say we'll be 100% long a month from now. Just like the fellow at Goldman Sachs, he was 65% sure of a recession 6 months ago. Now he's only 50%. Things change. So if things change, things will change. Right now we're long. Right now, you got to be long stocks. Right now, you got to be long stocks. I don't know what's going to happen 2 weeks from now. I can't tell you that.
But it sounds like you expect that you won't be long stocks in a month or two. So what are some of the signals that you expect to see, or it's just there's 60,000 of them, so you just know?
No. If the market peaked in July, you saw all you have to see in July. You saw a tight Federal Reserve. You saw an inverted yield curve. You see divergences, with the breadth, with many indices not participating. You see China peaking months before. You see Hong Kong peaking months before. You see what's so-called ordinary rally was accompanied by emotional buying based on the put-call ratio and based on the upside gaps. So you saw enough. And if you get a recession, all you need is a weak market. All you need is a market making a top followed by a recession, and it's all you need for the market to go down another 25-30%. We have enough in force. You don't need much more. Listen, pick any major top. Pick the 1929 top or the 1968 top or the 1972 top or the 1987 top. I mean, what did you have at the time? People were very bullish because they were only fine things you'd notice. In 1929, you noticed that European markets weren't making new highs along with the Dow. It's all you really noticed, and the fact that the SP had been the Federal Reserve had been tightening for a while. But it's all you really noticed. The market action was pretty great into the top, except for the divergence with the European markets. In the 1968 market, it was a major boom in low cap stocks. The large cap stocks were really lagging the low cap stocks, but that ultimately turned out to be negative because there's a sign of speculation. And again, you had President Johnson, the guns and butter policy, which is similar to our COVID policy, where they just threw money at the economy. And ultimately, once that it liquefies, it took the market on 68. In 1972, what you found was very interesting because while the Nifty 50 made new highs, they called it Nifty 50 in those days. The Dow Nifty made new highs. The stocks that peaked in 68, the small cap stocks never made new highs. They never got new highs in 1972. They stayed, similar to what you're seeing now with the Russell. The Russell not making new highs, while the S&P and Nasdaq are trading pretty nicely. So you always, it's very subtle what you see at market peaks. You have to recognize that at the time, being an astute technical analyst, but it's not like at a bottom where you see, even at a bottom where you see, panic selling and reversals and the Federal Reserve panicking and lowering rates. A top is more subtle, and this is a great top if it's a top because it's built up so slowly. In the background, you have a war. In the background, you had the reversal from a COVID easing. In the background, you have interest rates moving up. In the background, you have commercial real estate in shambles. I mean, let's face it. In the background, you have what I mentioned, the deflationary forces of the treasury market. The background for a major bear market is definitely here. The background is here. What triggered it? I'll give you a little analogy, actually, which I always use. And that is, you have a drunkard, right? Say you have a drunkard, right? If a drunkard's walking on a stable ground, the worst he can do is fall down, and fall flat, right? What if a drunkard is trying to walk on a tightrope? One fall for him at the end of his life. So the question is how, people look at a balanced market, they call it Goldilocks. There's two kinds of Goldilocks. There's Goldilocks that takes place after a major depression, or major recession, major decline, where everything is so low, you really can't fall much lower. You already had the liquidation of the debt. You already had the Federal Reserve tightening in the past, now they're loosening. You already had companies showing losses. But when you're at top of a market, it's sort of, you're walking on a tightrope. Any little shift of wind could knock you over. So I think we're in that situation now. We're on a tightrope. We don't have any. There's no broad fundamentals we're standing upon at this point. It's really very, very, very narrow, and I don't know what's going to shift. Anything can do it. China could do it.
Yeah, three consecutive quarters in a row, we've had year-over-year contraction in S&P 500 earnings, but a lot of that has happened as the stock. Actually, I think all of it has happened as the stock market's rallied, and that's because earnings expectations for 2024 and Q4 2023 are very high. So yeah, it's kind of priced to perfection. Milton, I want to ask you, if and when we have this bear market or correction, do you think, what are the odds that we take out the low in the S&P 500 from October 2022?
I think we will, because there's a pattern that's been manifesting in the UK, in the FTSE 100, which is called the Three Peaks and Don't House pattern. The book's written on this. It was discovered by a fellow named George Lindsay, who was a technical analyst in the 60s. And that pattern, in order to fulfill the completion of that pattern, the UK has to decline not only below its October lows, but has to decline back to its March 2020 lows. So if that pattern is going to work out, and that's going to go down to the March 2020 lows, there's no way, in a bear market, there's no way that the U.S. market's going to hold the October 2022 lows. So if you really want to bearish, if I could paint a bearish scenario, I'd rather not just paint it down to October lows. I'd rather paint it down to approach the March 2020 lows in a real bad recession. I'm not predicting that. I'm just telling you, we have to have in the back of our mind what could happen. And, any fundamentalist can really tell you what could happen. If Goldman Sachs is giving 15% chance of recession, he could give you a scenario where
I'll take the upper on that. I'll take those odds.
Yeah. Okay. Yeah. Okay.
That is greater than 50%. So Milton, three things I want to talk about. Thank you so much for your time. You are on Twitter at BergMilton, and for your institutional research website, it's miltonberg.com. As well, you have a book coming out in Target for the middle of 2024. So how do you distinguish what value do you provide, A, on Twitter, B, for your institutional research clients, and then C, what's coming out in the book?
Okay. The value on Twitter, it's very difficult. Twitter is really more for education. I'm not timely on Twitter. I can't be timely because my clients are really institutional clients, and it wouldn't be fair to them if I give timely. I just give a taste of what we're a small fraction of what we do, and only tweet. I don't. It's not post. I don't call tweet anymore. I only post. I rarely post, but I'm really doing it just to get people to get a new way of looking at the market. I mean, I see what I do on Twitter is quite different from what most people do. So I just want to give people some education, some sort of idea. I want to get a taste of what they're going to see in the book. The book is going through really. It's really good for people who are serious about the stock market. It's not a how to make money in the stock market type of a book. It's a book is showing you how to analyze markets. And if you follow and you study the book, you'll be able to analyze markets in the future and make money doing that. But the book will really go through, thousands and thousands of market historical scenarios and how they replay over the years. And it's really mainly for students. I'm hoping the book will be something that people will use, not just to put on the bookshelf, but actually to study as a way of studying the market. And I've had many mentors in this field. I learned from many people. I'm going to acknowledge all of them in the book and show mention what they've taught me. I'm not just a lot of what I write, what will be written in the book is things that I've learned from other people. Although, of course, there's much original stuff in there as well.
Thank you, Milton. I really appreciate you being so generous with your time and your insights. And thank you, everyone, for watching.
Thank you, Jack.